Imagine waking up one morning, reaching for your phone to check your bank balance, and discovering that you can no longer access your money. Your debit card doesn't work. The ATM refuses your transaction. Online banking displays a message telling you to contact your bank. For many people, this sounds like something that only happens to criminals or people involved in suspicious activities. But the reality is very different. Every year, ordinary people experience account restrictions, temporary freezes, and unexpected holds on their money. What surprises many retirees is that these situations can become more common as they get older. Now let's clear up one important misconception right away. Banks do not automatically freeze your account simply because you turn 65. There is no secret law that says the moment you reach retirement age, your bank can suddenly lock your money away. However, there are several reasons why older adults are more likely to face account reviews, fraud investigations, verification requests, and temporary restrictions. Understanding these reasons can help you avoid a financial nightmare and protect access to the money you've worked your entire life to save. To understand why this happens, you first need to understand how modern banks operate. Years ago, most suspicious activity investigations were handled by bank employees who knew their customers personally. Today, much of the monitoring is done by sophisticated computer systems. These systems analyze millions of transactions every day, looking for patterns that might indicate fraud, identity theft, financial exploitation, or criminal activity. The software doesn't know whether you're a hard-working retiree, a small business owner, or a college student. It simply looks for behavior that appears unusual. If something seems out of the ordinary, the system may flag the account for review. Sometimes that review happens behind the scenes and the customer never notices. Other times, certain transactions may be delayed. In more serious situations, the bank may temporarily restrict access to the account until additional verification can be completed. One reason seniors often encounter these situations is because scammers specifically target older adults. Criminals know that retirees may have substantial savings, retirement accounts, home equity, or pension income. As a result, seniors are frequently targeted by phone scams, email scams, text message scams, romance scams, fake investment opportunities, and identity theft schemes. Banks are well aware of these threats. Because of this, they often monitor transactions involving older customers more carefully than they did in the past. Imagine a retiree who has spent years making predictable transactions. Every month, the same bills are paid, the same grocery stores are visited, the same utility companies receive payments. Then suddenly a wire transfer for several $1,000s is sent to an unfamiliar recipient. From the bank's perspective, that could be a warning sign. The customer may genuinely be helping a family member or making a legitimate purchase. But the bank's fraud detection system cannot automatically know that. It only sees a transaction that doesn't match previous behavior. Another common trigger involves large withdrawals. Many people entering retirement begin moving money between accounts. They may transfer funds from retirement plans, sell investments, purchase property, help children financially, or adjust their financial strategy. While these actions are completely legitimate, they can appear unusual when compared to years of prior banking activity. If a transaction stands out enough, it may trigger additional scrutiny. Identity verification issues also create problems. Banks are required to maintain accurate information about their customers. If your address is outdated, your phone number has changed, or important documentation has not been updated, the bank may have difficulty verifying your identity when suspicious activity appears. In some cases, this can lead to temporary restrictions until the issue is resolved. Many retirees underestimate the importance of keeping their information current. They may move to a smaller home, relocate closer to family, spend part of the year in another state, or change phone providers. If the bank attempts to contact them regarding a potentially suspicious transaction and cannot reach them, the institution may take protective action. While frustrating, the bank often believes it is acting in the customer's best interest. Technology has also changed the way criminals operate. In the past, identity theft required significant effort. Today, cybercriminals can obtain personal information through data breaches, phishing emails, fake websites, and social engineering schemes. Sometimes criminals know enough information about a victim to convincingly impersonate them. This creates a difficult challenge for financial institutions. Banks must balance customer convenience with security. If they become too relaxed, fraud increases. If they become too aggressive, Innocent customers experience disruptions. This balancing act explains why some account freezes seem to occur without warning. The bank would rather temporarily inconvenience a customer than allow a criminal to steal thousands of dollars. Unfortunately, that means legitimate customers occasionally get caught in the system. There is another factor many people don't realize. Federal regulations require banks to monitor accounts for signs of money laundering, fraud, and other financial crimes. These regulations apply regardless of a customer's age. If certain transaction patterns resemble activities commonly associated with financial crime, banks may be obligated to investigate further. Again, this does not mean the customer has done anything wrong. It simply means the institution must verify what is happening. For retirees, this can be particularly stressful because many live on fixed incomes. Missing access to funds for even a few days can create significant anxiety. Mortgage payments, utility bills, insurance premiums, and medical expenses continue regardless of whether an account is under review. That's why prevention is so important. One of the simplest ways to reduce risk is communication. Before making an unusually large transaction, contact your bank. If you're planning to wire money, move funds between institutions, travel internationally, or make a major purchase, letting the bank know ahead of time can help reduce the likelihood of a fraud alert. Many customers assume this step is unnecessary. In reality, a brief phone call may save days of frustration later. Another critical step involves monitoring your accounts regularly. Many retirees still prefer paper statements and may only review their finances once a month. While there's nothing wrong with paper records, fraud can happen quickly. Regular account monitoring allows suspicious activity to be detected early, often before larger problems develop. One of the biggest mistakes people make is assuming that if they have never experienced fraud before, they are unlikely to become a target in the future. Unfortunately, scammers don't care whether someone has been careful for 20 years or whether they have never shared personal information online. They cast wide nets, contact thousands of people, and only need a small percentage of victims to respond. This is why education is one of the most powerful financial security tools available. The more you understand how scams work, the less likely you are to become a victim. Many scams begin with something that seems completely harmless. A text message claims there is a problem with your bank account. An email says a suspicious transaction has been detected. A caller identifies themselves as a representative from the fraud department. The message creates urgency and encourages immediate action. The victim is told that their account could be frozen, compromised, or emptied unless they respond quickly. Fear takes over, logical thinking slows down, and the scammer gains control of the conversation. What makes these scams particularly dangerous is that they often contain enough personal information to sound believable. Criminals may know your name, address, phone number, or even details about previous financial institutions you've used. This information can come from data breaches, public records, social media profiles, or information purchased on criminal marketplaces. When victims hear accurate personal details, they assume the caller must be legitimate. Banks understand these tactics, which is one reason they sometimes take aggressive action when unusual account activity appears. Imagine that a customer who normally makes small local purchases suddenly begins transferring large amounts of money to unfamiliar destinations. The bank's systems may recognize a pattern commonly associated with fraud victims. In some cases, a temporary restriction can actually save someone from losing their life savings. Retirees are often particularly vulnerable because they tend to have accumulated assets over many years. Unlike younger individuals who may still be building wealth, many retirees possess substantial savings, retirement accounts, investment portfolios, or home equity. This makes them attractive targets for criminals. Fraudsters know that convincing one retiree to send a large wire transfer can generate far more money than targeting dozens of younger victims with smaller balances. Another issue involves cognitive decline. Not every older adult experiences memory problems or reduced decision-making abilities, but banks are aware that age-related cognitive changes can affect some customers. Financial institutions have developed training programs to help employees recognize warning signs of potential exploitation. If a bank employee notices behavior that seems unusual, they may ask additional questions before processing certain transactions. While some customers view this as intrusive, the intention is often protective rather than restrictive. Consider a situation where a customer who has never sent international wire transfers suddenly requests several large transfers to overseas accounts. A trained employee may ask questions about the purpose of the transaction. If the customer appears confused or unable to explain why the transfer is necessary, additional review may occur. These conversations can feel uncomfortable, but they have prevented countless fraud losses. Technology has also changed customer expectations. Many people expect instant access to funds, immediate transfers, and real-time transactions. Most of the time, modern banking systems deliver exactly that. However, speed can become a problem when suspicious activity occurs. Banks sometimes need time to verify information before releasing funds. The delay may feel inconvenient, but it often exists because the institution is attempting to balance convenience with security. Some customers become frustrated when asked to provide identification multiple times. They may wonder why a bank that has known them for years suddenly requires additional documentation. The answer often lies in regulatory requirements and changing security standards. Identity theft techniques continue evolving, and financial institutions must adapt accordingly. What was considered adequate verification 10 years ago may no longer be sufficient today. One area where many retirees unintentionally create risk is through shared devices and public internet connections. Logging into financial accounts from public Wi-Fi networks, shared computers, or unsecured devices increases exposure to cyber threats. Criminals constantly search for vulnerabilities that allow them to capture login credentials or intercept sensitive information. A compromised account can trigger fraud investigations and account restrictions even when the customer has done nothing intentionally wrong. Maintaining secure devices is therefore essential. Keep operating systems updated, install security patches promptly, and avoid downloading software from untrusted sources. While these precautions may seem technical, they represent some of the most effective ways to reduce financial risk in the digital age. Social engineering remains one of the most successful methods used by criminals. Unlike traditional hacking, social engineering focuses on manipulating human behavior. The scammer doesn't need to break into a computer system if they can convince the victim to provide access voluntarily. They create emotional pressure, establish trust, and exploit fear, greed, loneliness, or urgency. Retirees are often targeted through investment scams, promising unusually high returns. The scammer presents what appears to be a legitimate opportunity, complete with professional documents and convincing explanations. Victims are encouraged to move money quickly before the opportunity disappears. When large transfers suddenly occur, banks may become suspicious. In some cases, fraud prevention systems identify warning signs before the victim realizes a scam is taking place. Family-related scams are also increasingly common. Criminals may pretend to be grandchildren in distress, claiming they need money immediately due to an emergency. They often instruct victims not to contact other family members and create a sense of urgency that discourages verification. These scams succeed because they exploit emotions rather than logic. A concerned grandparent naturally wants to help. Banks understand this dynamic and sometimes intervene when transactions appear connected to known scam patterns. Another important consideration is estate planning. Many retirees focus on investment performance and retirement income while overlooking the practical aspects of financial access. If an account holder becomes incapacitated, family members may face significant challenges accessing funds without proper legal documentation. While this does not directly cause account freezes, it can create situations where money becomes difficult to access during emergencies. Establishing powers of attorney, reviewing beneficiary designations, and organizing important financial records can reduce confusion later. These steps help ensure that trusted individuals can assist when necessary while maintaining appropriate safeguards against abuse. Some people worry that keeping large balances in bank accounts automatically increases the risk of freezes. In reality, account balances alone are rarely the issue. Banks routinely manage accounts containing significant amounts of money. What attracts attention is unusual activity, inconsistent behavior, or patterns associated with fraud and financial crime. A customer with a large balance who conducts predictable transactions may attract far less scrutiny than someone with a smaller balance engaging in unusual transfers. The emotional impact of account restrictions should not be underestimated. Financial access provides a sense of security and independence. When that access is interrupted, even temporarily, stress levels can rise dramatically. This stress sometimes causes customers to make poor decisions, such as responding to suspicious messages or sharing information with individuals claiming they can help resolve the problem. Scammers frequently target people during moments of uncertainty because emotional distress makes manipulation easier. This is why preparation matters. Knowing what steps to take before a problem occurs can prevent panic later. Keep important contact numbers available. Maintain copies of identification documents in a secure location. Understand your bank's procedures for reporting fraud and verifying identity. Familiarity with these processes makes it easier to respond effectively if an issue arises. Financial literacy remains one of the strongest defenses available to retirees. Understanding how banks operate, why fraud prevention systems exist, and what behaviors trigger reviews allows customers to make informed decisions. Instead of viewing security measures as obstacles, they can be seen as tools designed to protect assets accumulated over a lifetime of work. The banking environment will continue evolving as technology advances. Artificial intelligence, biometric authentication, behavioral analytics, and real-time monitoring systems are becoming increasingly sophisticated. These innovations offer significant benefits, but they also create new challenges. Customers who stay informed and adapt to changing security practices will be better positioned to protect their finances. Ultimately, the question isn't whether banks can freeze accounts after age 65. The more important question is how individuals can reduce the likelihood of experiencing unnecessary restrictions while maintaining strong protection against fraud. The answer lies in preparation, awareness, communication, and vigilance. Keep information current. Monitor accounts regularly. Verify unexpected requests. Use strong security practices. Communicate with financial institutions before major transactions. And most importantly, never assume that financial scams only happen to other people. Every year, intelligent, careful, responsible individuals become victims because criminals are constantly refining their methods. The goal isn't to live in fear. The goal is to stay informed. Knowledge allows you to recognize warning signs, avoid common traps, and respond confidently when unusual situations occur. Your retirement savings represent decades of hard work, sacrifice, and planning. Protecting those resources requires more than simply choosing the right investments. It requires understanding the systems that safeguard modern banking, recognizing the threats that exist in today's financial world, and taking proactive steps to maintain control of your financial future. By doing so, you dramatically reduce the risk of disruptions and ensure that your money remains available when you need it most. The individuals who experience the fewest problems are often not the luckiest ones. They are the ones who prepare, stay alert, and understand that financial security is an ongoing process rather than a one-time achievement.